Germany in a
The Bond Report is brought to you by PIMCO.
For Sweden together with Finland, could that also file an application for NATO? And that's why we're so eager also get into the alliance, and we think that we can be security providers to the alliance because we have assets and capabilities that can make NATO stronger. We have a strong air defense, we have Patriots, we have Gripen fighters, we have submarines, we have a strong defense industrial base. We also have great Russia expertise in our intelligence community.
He's the U.S. Special Presidential Envoy for Climate.
If we will generate enough economic activity around the explorations that need to take place, we can win the battle.
2024, the election coming up. What happens if there is a change of government?
I do not believe any one politician or any one country could turn around what is happening with respect to response to climate.
I sit down with John Kerry on the next Sustainable Future.
Now is not the time to be a hero. That is the advice from our next guest as the S&P 500 tries to avoid its longest daily losing streak since December. Let's bring in Sebastian Page, T. Rowe Price, head of Global Multi-Asset and Chief Investment Officer. Welcome back. It's good to see you. I mean, it's obviously so easy to be bearish. All you have to do is tune into any program, and most people who come on lay out the negative case because it's easy to make. But why are you?
Yeah, the bearish narrative is easy to make, and I'm going to start by saying I'm not an uber bear, but I do think that it makes sense right now to be underweight stocks. I mean, just think of the bearish narrative, and you just had a guest kind of go through it. The yield curve is inverted 80 basis points. PMIs are dropping like a rock. Manufacturing down 16 points. Services down 20 points, even though they've jumped back up. Inflation is sticky. You had a guest talk about the equity risk premium. It's as compressed as it's been since the great financial crisis. Earnings expectations look high at 3.5%. Our models predict that housing could go down 7 to 10% this year, and on and on. The leading indicators are flashing red. You know, we've had a few good prints, retail sales and employment and so on, but really the bearish truck is coming, Scott.
I know, but there's no indication that the bearish truck is going to, smack into the wall. If look, Jamie Dimon has been, notable for being out there with some, pretty bleak calls when he talked about there being a hurricane. And I know that you know exactly what I'm referencing. And he was on the network today, and he could have doubled down on that, and frankly, he did not. He still maintains there's a chance for a soft landing. Bullard, economy stronger than we thought. Markets overpriced a recession in 2023. Have we just gotten too uber negative, given how strong the economy, at least at this moment, still appears to be?
I think so, Scott. And I heard Jamie Dimon, and he was more nuanced today. And one of the reasons why this uber bearish set of data has to be interpreted a little bit differently is that we still have about $2 trillion of accumulated savings. Now, the bears will all say, and again, I'm one of them, I'm just a more nuanced bear, they'll all say, well, we're drawing down on these savings, but $2 trillion of accumulated savings going into a recession is a very unusual, never seen before situation. And you had Stephanie earlier talk about
market data connection
and the
re-established.
strength of the consumer, 3%, retail sales in January. That's pretty good. The employment market is just really strong. And yes, everybody will say, the bears will say, look, it's just a lagged effect. And I agree with it. You have to wait it out. You've had 475 basis points of hikes. Let's see, let's let time pass to see how this is going to unfold. There is a lagged effect. And employment is a lagging indicator. But still, I mean, we just created 517,000 jobs. And the claims are coming in low at 192,000. So after 475 basis points of hikes over a year, we have a 50-year low in unemployment. So there's something about the response function of the labor market to the Fed tightening that makes it look quite resilient.
At least at the current time. Now, you say you are playing quote unquote aggressive defense. What does that mean?
We talk about the market being expensive at 18 price earnings ratio. There are areas in financial markets that asset allocators are getting pretty interested in because they are actually cheap. I talk a lot about quality small caps, the S&P 600. The price earnings ratio there is so depressed to 2008 financial crisis level. It's hovering around there. So to me, those quality small caps are pricing in a very hard landing. So I'm comfortable, and it's nuanced, playing offense and defense. I'm comfortable being underweight stocks, having a cash buffer, waiting to get back in, but at the same time, being long small caps. No one wants to be long small caps into a recession. This is actually right now an opportunity to be contrarian and add some juice to the portfolio for the next 12 months. I happen to think that high yield bonds at over 9% yield are attractive as well from an asset allocation perspective. Despite fairly tight spreads, you have low default rates, and 9% yield on high yield bonds to me is a more attractive risk return trade-off than just straight stocks exposure.
Speaking of being contrarian, obviously the move in technology to start the year has caught a lot of people by surprise. It doesn't sound to me like you could possibly be a believer in the move that we've seen in that area of the market to start the year.
The thing with technology is you have to separate between the non-earners and the more speculative and maybe the crypto space, and then the companies that are able to grow cash flow. Some of our portfolio managers really like the growth at a reasonable price types of companies. I'm not a stock picker. Look, from an asset allocation perspective, we're tilting towards value. So this says something about, from the top down, how we think about technology. But I do think that the speculative part of technology that has done really well year to date has been mainly driven by the super depressed positioning. And the one thing I would say, Scott, is we talk about the equity risk premium. A lot of investors are waiting for tech price earnings ratio to go back to where they were when rates were at 2% on the 10-year. But really now with rates at 4% or around 4% on the 10-year, that might actually not happen. So you have to be selective.
All right, we're going to leave it there. Sebastian, I appreciate your time very much. We'll see you soon.
Thank you, Scott.
That's Sebastian Page. T. Rowe Price joining us. Up next, we're tracking the biggest movers as we head into the close. Seema Modi is standing by with that. Seema.
Scott, we are seeing this growing trend this earnings season where Q4 numbers are beating expectations, but the guidance for the rest of the year falling short. We're going to bring you two names following that trend after this short break.
From the city of mountain and sea, we hear nature's call. We witness a miracle from 40 years of glorious history. We feel the vitality and innovation from the pulse of the city. We see the city of dream from the ongoing glories.
Content is key. A non-branded film about real lives.
Not branding the film was very intentional. I wanted the story to be about the journey of the person.
It was a huge leap of faith, and if we didn't have that relationship, we wouldn't have done it.
A takeover evening to get the message across.
I've made it focus on people, adding an abstract element to it, with their logo in the middle.
We explore Publicis Sapient's new campaign on the next Marketing Media Money.
About 20 minutes to go until the close of regular trading, and we're trying to make a little move here. Dow's up by about 137, 140 as you see there. Microsoft and Chevron and Boeing among the leaders there. S&P on pace now to close back above 4,000, so we'll have to watch that closely. And then the NASDAQ, of course, getting that nice lift today from NVIDIA, which is up 14%, having its best day in a long time. Let's get back to Seema Modi for a look at the key stocks to watch as we approach the end of regulation.
Yes,
Seema.
I like that, Scott. Two longtime holdings of Cathie Wood under pressure today, starting with Unity Software down over 10%, 14% after very weak first quarter and full year revenue guidance. That is due in part to weakness in the advertising market, which Unity does not expect to recover in 2023. And turning to Teladoc, which also issued weaker than expected guidance, that stock has fallen more than 90% from its February 2021 all-time high, but at least stock currently trading at 27 a share. By the way, tune in next hour. We will hear from Unity Software CEO. That's coming up. Scott, back to you.
All right, good stuff. Wow, 90% down for Teladoc from the high. That's crazy. Seema, thank you. That's Seema Modi. Last chance to weigh in on our Twitter question. We want to know, would you buy NVIDIA even with today's big gain? Head to @CNBC Closing Bell on Twitter. Vote. We're going to bring you the results after this quick break.
What makes us who we are, if not the way we experience the world? Because world class is everything we do. Welcome to world class. Welcome to Singapore Airlines.
China is very important for Australia in general because the largest visitors internationally that came to Australia were Chinese. So we think that's going to be great for our economy here, which has a knock-on effect on the Qantas. And we get the benefit of those Chinese visitors domestically, which are a huge proportion of people traveling around the country. So we're optimistic that that starts recovering, and that will be good for us, particularly in our domestic business.
Soldier-turned multi-million selling musician James Blunt reflects on 18 years in the industry.
The audience want to just hear songs from your heart that are genuine, that really mean something.
He talks new ventures.
I absolutely love having a pub. It's the best thing I've ever done, really.
And becoming an unlikely social media superstar.
The moment they invented Twitter, my label said you can sell your music, and I thought, no, I'm just going to take the mickey out of myself. People were having a go at me, and I could have a direct voice to reply.
That's all in the CNBC Conversation.
The results of our Twitter question, we asked, would you buy NVIDIA even with today's big gain? And you said no. 69% said no. I mean, the stock's up 14% after a huge run, doubled off the bottom. I can understand that. Up next, top technician Mark Newton is flagging a must-watch signal for a potential market rally. That and much more when you take you inside the market zone.
Enter into partnerships with government and local communities to make sure their protected areas are managed sustainably. Our goal is that 40 protected areas are under our management by 2030, so we can make sure that these
CNBC presents The Brave Ones, profiles of bold leaders who took the leap and changed the world.
I think our move into space has been our boldest move.
He's a high-flying CEO pushing the envelope at every turn.
He's a rock star within the business world.
With an extraordinary vision for the future.
He has always been at the edge of pushing the next thing.
The Brave Ones, Richard Branson. CNBC.
Russia has a very low threshold for the use of military force. and it takes great political and military risk. We have assets and capabilities that can make NATO stronger. We have a strong air defense, we have Patriots, we have Gripen fighters, we have submarines, we have a strong, no other country of 10 million who can produce submarines, fighter aircraft, very advanced combat vehicle, artillery systems for example, and we also have great Russia expertise in our intelligence community.
It is that time. We are in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus, Citi's Scott Kronert with his market outlook. FundStrat's Mark Newton here as well with a chart he says you must watch. All right, Mike Santoli, I'm looking at S&P. Looks like we're going to close above 4,000, barring some crazy finish here. Important or not?
I wouldn't say of paramount importance, but I think the traction's interesting that we found in this afternoon. Sometimes the short-term moves are pretty inscrutable. Sometimes the mechanics are right there out in the open. A little over 2 hours ago, 10-year yield starts backing off, cracks through 390, goes lower, S&P takes off right away. So to me, that's right now the seesaw that we're on. That doesn't have to be the case longer term. I think it's happening in the context, as we spoke about a couple days ago, of what could just be a 5% shakeout. The trend looks a little bit better than it did the last time we kind of rolled over from a rally high. You're starting to see, we gave up about half of the latest move, but no more than that. So far, the economy's not getting worse fast enough for those economy bears to be right, and then it's really the yield stuff to be afraid of, and that's why we got some relief this afternoon.
All right, Scott Kronert, you don't expect much more upside from here, but how much downside do you expect, if any?
Well, we're viewing the S&P as fairly valued right around the 4,000 level. So we're kind of playing in more of a trading range right now, where we were a week or two back. As we approach 4,200, probably the higher end of that range. We went into this year thinking that 3,700 was an appropriate downside target, at which point we'd want to get more aggressive in terms of buying stocks. We haven't really backed off of that. I think what I would point out is that it's kind of interesting with today's action. You're closing the 10-year right about where we started the year. This year really has been, in our view, a matter of following rates up and down with the influence on that mega cap growth cohort of the S&P.
So we're prisoner to rates. I mean, that's just the way it is going to be for the foreseeable future. If rates tick up, stocks are going to tick down. Mike was talking, too, about what the 10-year had done and the way that stocks reacted as we head towards the last few minutes here.
Right. Well, I mean, that's the way we see it for now. But again, it's important in terms of teasing out where this is being felt. And we've been making this analogy that the S&P can't go materially higher without the NASDAQ essentially leading it. And that's where that rate sensitivity comes in. It's more specific to that large cap growth part of the market that last year proved to be so sensitive to rates on the multiple compression side. That's where your release valve is up and down as we follow the shorter term rate direction.
Yeah, so Mike, okay, 4,000 is where the level that Scott sees. You heard Eric Johnston, Cantor, low 3,000s is where he thinks we might trade. How do you react to that?
I mean, it's both plausible. I would absolutely say that. To me, the October low has looked pretty good. It's had a lot of the kind of characteristics of something where it should actually be relatively durable. And I keep pointing out that was sort of a stagflation narrative that was driving us there, right? So if you're talking right now about, oh, economy's better than expected, maybe the Fed has to go an extra quarter point or so, that's not fatal to where we are right now. It doesn't necessarily mean you retrace all the way lower. Would the market be more attractively valued down there? Would it mean better forward returns from that level? Absolutely. I mean, that's the trade-off. You want the pain now and set up a much better rebound, or do you want to sort of hold these levels and then maybe have it be more of a grind from here?
Scott, when you hear people like Eric Johnston make a call like that, can you get your arms around how we could go down to the low 3,000s in his thinking?
We feel pretty good with where we are with our S&P earnings outlook for this year around this 216 level. I think to talk about an S&P level that's closer to that 3,000 level, I mean, you need to have a much more dire circumstance unfolding in terms of recessionary influence on the earnings outlook. We don't see that in the cards, if certainly for the first half and most likely into the second half. So again, my emphasis would be that earning stability here probably limits some of your downside, which makes us more susceptible to the interest rate movements as a key driver of this.
I appreciate you being here, Scott. Thank you. Mark Newton, to you. You are the level guy. You're the one who looks at all this stuff. 3,000 or 4,000? What makes more sense to you?
Well, I'm a bull, Scott. Look, I don't think we've seen sufficient deterioration to think that this bull market rally has run its course. We pull back exactly to where we need to really hold the uptrend from October. It's about a 50% exact retracement in both price and time to the move up from late December. This whole narrative shift over the last couple of weeks with the stronger economic data has caused sentiment to get worse and worse and worse. And so now we're actually approaching pretty bearish near-term sentiment levels. And look what's just happened in the last 24 hours. Now we see Treasury yields starting to roll over. And that is specifically what investors need to be watching to think that this market likely can extend. The market meaning both the bond market, but also the stock market, in my view.
Wait, so you think rates may have topped for at least the near term again?
There's certainly enough evidence when you look at just a trend over the last few weeks and getting down. We're at, 387 today. If we break earlier week lows 384, then that's going to jumpstart a pretty big Treasury rally over the next couple months. And I think equities get up towards 4,200. Above that, could get up towards last August highs, 4325 or so. So, I think, look, we have weekly momentum clearly in place. Breadth is actually in very good shape. Now we're combining that with skepticism, with pessimism. Everybody thinks, the central bankers are so hawkish, we have to continue to hike. Well, rates might not do exactly what they're saying. We're actually seeing evidence that they can peak out here and roll over. So if that happens, equity markets are going to rally.
You want to take a stab at this, Mike? You look at the internals. Brett, does it look good to you like it does to Mark?
In general, it has looked good. So that's kind of built up this base of, benefit of the doubt that you might be able to give the market at these levels. Valuation's not compelling, but it's also not going to be fatal to further upside. Keep pointing out that outside of the very largest stocks, valuation's really not that challenging. And I also don't think that it's the level of rates that corresponds to a particular index level. I keep pointing this out. We were at 4,000 the S&P in May of last year, and we were at 3% on the 10-year. So it's the speed of the move. It's what it means about whether we're chasing inflation or not. Real rates are now actually, pretty generous at this point. Arguably, bonds become a good buy. Maybe that means that yields can hover or come in a little bit.
And Mark, you mentioned this sentiment shift. I think with the way that you characterized what we've seen over the last couple of weeks. It's been justified, hasn't it, though? You got that really strong employment report, and that made everybody sort of stand up and say, uh-oh. Yeah, you know what that means? More hikes and higher for longer.
Well, that's the entire point, Scott, is that when everybody leans in a certain direction, you generally don't want to be there for very long. Look, you saw the equity put-to-call ratio hit the highest levels of the year yesterday at 0.80. AII sentiment is now back to bullish. The CFTC data with large specs are still very negative, minus 200,000 short S&P contracts. And you actually see CFTC data also being quite negative for treasuries also. The lowest levels we've seen, the highest levels we've seen in shorts for almost 4 years. So that's interesting to me. It means that people clearly are all betting that rates are going to go higher and that stocks should go lower. I like to take the other side of that, So in the words of Trey Anastasio and Tom Marshall, everything's right, so just hold tight. I think we move higher. And in general, weekly momentum and breadth support my view. you know, I think we're going to be fine. And really any further pullback that causes sentiment to get even more bearish, that's going to create a really good opportunity. I don't think S&P gets below 3,900. Today's move looks important, but it's really 40-60 that we need to get above. Above that, we can really start to accelerate higher. So, you know, I like technology. The move in semis today continues to be very, very good. The majority of your polls suggested people don't want to buy NVIDIA. Well, the SOX is showing tremendous strength. It's the best part of technology. People need to be in semiconductors, and increasingly they're going to want to be in counter-trend pullbacks for groups like energy and also healthcare. They're going to start to look a lot better in the months to come.
Well, we've got a lot of negativity on the program today from many people, but Mark, I appreciate you bringing that different perspective to us. I think we'll be fine. Technology, like semis, good. I mean, does NVIDIA's strength today speak for all the semis?
I would say it doesn't speak to the strength in all the semis, but it is feeding off of a reset in attitudes about the group. I was saying earlier, the consensus price target on NVIDIA is right where the stock is right now. It's 236. You know why? Everyone was too bullish when it was way higher a year ago. They kind of cut their estimates. Expectations came down. So that process, I think, can support things for a while. Also seen some data about outflows from S&P ETFs as well as the QQQ over the rolling last 2 or 3 months. It's reached actually kind of extremes to the point where you'd say that people are not all in. So yes, there was a big grab for risk at the beginning of this year. You've talked about the short covering element of that, but also a chase. People definitely thought that they kind of found the old magic in some of these old stocks again, but it faded quickly. In other words, as soon as the market stopped going up, as soon as the high growth speculative names rolled a little bit and gave back some of the gains, you did have people back away from those bullish bets.
If Newton's going to be right with his call, which is certainly more bullish than many, does he need technology to perform well to get him to where he thinks we can go?
It's the shortest path. You need the big growth stocks to work to some degree to get there. Without it, you sort of, a lot more has to go right in terms of other sectors. I still keep pointing, though, to more traditional cyclical areas that have kept afloat. Home builders, maybe they shouldn't, but they've been outperforming.
Industrials, if you're worried about the economy, how many days have we talked about industrials hitting new 52-week highs or even new all-time highs?
Truckers, industrials, and industrial metals, things like steel and copper. So, again, that market, those could be head fakes internally, but they can't all be false moves.
Yeah, well, important or not, I mean, closing above 4,000 on the S&P is going to be viewed by some as very important. And we'll see. We look like we're going to do that. I'll see you tomorrow. It does it for us here on Closing Bell. Let's get to overtime with Morgan Brennan and John Ford.
Well, you got the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort, along with Morgan Brennan. And Morgan, the earnings are going to be coming fast and furious this hour. We got reports from Carvana, Block, Booking Holdings, Intuit, Warner Brothers Discovery, Autodesk, and more.
That's right, and we're going to bring you all those headlines as they cross. Plus, we're going to talk to the CEO of Unity Software, which is falling sharply today on the back of that company's results.
But let's get straight to our market panel. Joining us now are Adam Crisafulli from Vital Knowledge and Paul Hickey from Bespoke Investment Group. Adam, you've been saying that dips to 4K or lower should be bought, and that's exactly the right playbook for today. We ended up right around that level. But what do investors do from here, would you say? Add to positions and wait for dips, or try to look for the next Palo Alto Networks, the next NVIDIA?
Yeah, I think for the broader S&P, dips down, to the level that we got to yesterday, especially below 4,000, which we were below briefly, should be bought. I think you're in, you're in a tough patch of data right now that has helped move yields higher. I think we're going to move out of it relatively soon, the next couple of weeks. I think you're going to see more pronounced disinflation set back in. I think you're going to see the jobs momentum fade off of that big, hot January figure. So that's going to help relieve some of the pressure from yields and from Fed hawkishness. And then I think earnings overall over the last several weeks, it's been far from a perfect season, but I think companies are a lot more resilient than they're often getting credit for. I think there are a bunch of underappreciated earnings headwinds that will help prevent really aggressive cuts to estimates on this year. And then as over the next couple of months, we're going to start to look into 2024 in terms of valuations. And that's when things are going to look a lot cleaner. And so I think dips down to this 4,000 level should be purchased. I think the near-term ceiling will stay around 4,200, but in the medium term and as we move into the spring and summer, I do think that the back half looks more encouraging.
Yeah, Paul, how do you see it? I mean, we saw yields under a little bit of pressure today. We saw tech stocks really leading the rally. The NASDAQ, the best performer of the major averages, up almost 1% today, perhaps not surprisingly on the heels of NVIDIA and then the subsequent move higher we saw in other chip stocks as well. Earnings not as bad as feared, and does that create a little more of a tailwind given all of the negative sentiment we've seen in recent weeks for this market?
Yeah, so Morgan, I think if you look back at this earnings season, what everyone was expecting to be a complete disaster wasn't so bad. You saw the earnings beat rates now that earnings season is done. You saw it weaker than the last few quarters, but still above the long-term average. The revenue beat rate was above the long-term average. And guidance, you would have expected to see horrible guidance coming from companies, but it wasn't out of the norm from what we normally see. And that just goes against the narrative of what we saw coming into the earnings season. So it was a very big surprise. And I think the most surprising aspect, if you look at your screen right now, is that the NASDAQ is up this month. The S&P is down about 1.5%. That comes in what is normally a weak month for the markets, but also more importantly, the pause that everyone has been waiting for has been pushed way further out on the horizon. So I think in that respect, you have to take a step back from the market and think, with all of these bad headlines coming out there, why is the market holding up better than it should be given the headlines? And that just goes to show that investing based on the headlines is never the approach you want to take in investing. It's just on a road to ruin by following that framework.
Yeah, it was looking particularly rough for tech to start the year. I remember talking to you about that in early January. Right now, Paul, we're right near those levels that the NASDAQ rebounded to in late November after that big sell-off in early November. So in tech right now, do you believe Tuesday's tumble, today's modest rally? I know you say you can't follow just the stock price, but even based on the fundamentals we've seen from earnings so far this week, how much do you believe that?
I think you've seen some good news in some, especially in the high multiple stock like NVIDIA going up so much today, especially after it's rebounded so much. That's, a story with the whole AI play, that's one thing. But we've seen other companies doing well here. And the fact is that while you have some areas of tech with very high multiples, you can find other areas that aren't so rich. And in the broader market overall, you look to the small cap space. Small caps in the S&P 600 are trading at about 2/3 the multiple of large caps. They're trading about 13 times earnings, which when all the talk about how high valuations are, you have small caps with relatively attractive multiples.
All right, hold on just a moment. Warner Brothers Discovery earnings are out. Stock moving lower about 4%. Julia Borston's got the numbers. Julia?
John, stock moving lower and revenues falling short of expectations, coming in at $11.01 billion versus expectations of $11.36 billion. The company reporting an earnings per share loss of 86 cents. We're not comparing that to estimates for now, but I do want to point out a couple of key areas here. Direct-to-consumer subscribers. So the company announcing it has 96.1 million D2C subs. That's just a hair less than the 96.3 million expected. But one thing that's notable here, one bright spot, though the stock is down 2.4%, is that the losses for the D2C division were much less than expected. There's always a lot of conversation about how much these media companies are spending on their direct-to-consumer business. Loss of $217 million for that D2C division. Analysts were expecting a loss of $571 million, so much smaller loss than anticipated. No forward guidance here, but just want to point out average revenue per user in that streaming business, $7.58, just below the $7.65 estimated. I'm looking for that forward guidance. I'm sure we'll get some more on the call with CEO David Zaslav. Shares now down about 3%.
All right, Julia Borston, thank you. I want to bring it back over to the panel. Adam, I mean, you look at what underperformed today was communication services within the S&P, and Netflix was down almost 3% on those headlines that it was cutting, or it is going to cut subscription prices in some countries to boost the numbers. Then you get this report, and I realize we're still going through some of the details here, but how does it speak to I guess some of the uncertainty around this area of media and this area of the market that was until more recently high flying, and where now it's all about the path to profitability. It doesn't really matter about growth anymore.
No, absolutely. I think there's certainly a little bit less emphasis on just raw subscriber figures. I think for Warner Brothers specifically, it's in a little bit of a unique situation in that it has, among the large media companies, one of the worst balance sheets. So I'd be very curious within this Q4 report to see the free cash flow number. I think that's by far the most important number in the entire report. I think the consensus on free cash flow was about $2 billion plus, so a very big number. If they fell short of that, and then depending on what they say in the call, that's going to be a lot more disappointing than if they miss on streaming subs by a little bit. I think cash flow is something people are really watching for with this company, just given the balance sheet stresses that it faces.
Well, the earnings results brigade is upon us. Booking Holdings earnings are out as well. Seema Modi has those numbers. Hi, Seema.
Morgan, a better than expected report from Booking Holdings. Earnings of $24.74 adjusted. Revenue above $4 billion at 4.05 versus the estimate of $3.89 billion. Gross bookings $27.3 billion. That is better than the BTIG estimate of $26 billion. And just for comparison, seeing growth of about 44% year over year versus Expedia, which in the fourth quarter saw gross bookings grow by 17%. So that just gives you some context as to how big of a beat it's seeing in terms of growth in gross bookings for Booking Holdings. China and its exposure to Asia will be a big topic on the earnings call, which begins at 4:30 p.m. And CEO Glenn Fogel in the earnings release saying we are encouraged by the continued strength and resiliency of demand for travelers last year and into the new year. Clearly a consistent trend we've seen across the sector. Morgan?
All right, I'll take it, Seema. Thank you. Adam, I don't know if you've got any thoughts on how do you sort through how much is just revenge travel and the shift towards services here and the quality of some of these travel companies, travel tech companies' results, and how much of it is just really great operating?
I think a lot of it, certainly there's a lot of pent-up demand, and that's helping these companies. I also think that they went through an extraordinarily stressful time during the pandemic, so they're coming out of that stronger, leaner. But clearly, the strength that we've seen in travel, so Booking, go back to Airbnb, all the airlines, the hotel companies, all of them have been very bullish. And it's kind of the corollary of what you saw today with companies like Domino's or Wayfair or Yeti or all these other consumer companies that are levered more towards hard goods, discretionary spending. This big shift in the consumer wallet from goods to services continues, and you can see that reflected in the results that we just got out of Booking and then Airbnb a couple weeks ago. So unclear how long this pent-up demand will last. You're probably pulling forward a little of it, just like during the pandemic you had a big pull forward of hard goods demand. This is certainly probably pulling forward a little bit, and it could create a little bit of pain next year. But for now, travel is extremely strong, and the whole industry is benefiting.
Yeah, I'm gonna stay on this theme, Paul, because the shift that we have seen, and we've seen it in the macro data too, right? The shift from goods to services. You saw it in earnings reports and commentary from companies, even just earlier today, particularly on more of the retail side. The fact that there's cautious outlooks afoot. Travel stayed really resilient. At some point, if we're talking about an inflationary environment where prices are still elevated, where travel is concerned, which seems to be the case on a monthly basis, do consumers start to push back on that too?
Yeah, I think I was just looking through, we saw one survey, spring break travel plans. People have adjusted their plans into this year because of the high prices. They're still going, don't make no mistake about it. Just everywhere you look, the areas of the economy that are strong are in services, employment, leisure is the strongest sector in there. So that area is on a big rebound right now, and it's probably got more to go, at least through this year. But then as you get into next year, these companies are going to start facing the same problem that a lot of these hard goods and work from home stocks faced last year and are facing now, tough comps. And that's going to have to work itself out going forward. You saw Warner Brothers Discovery, having trouble, these streaming companies, that area of the market, there's a very cutthroat area. Interest rates are higher. It's going to be very expensive to produce content. So these areas that did so well are still facing an adjustment process, while the travel and leisure stocks are doing well. And I think they may have more to run. But again, you got to focus on some of these valuations and look ahead to a year from now. Will, or like you said, Morgan, still be willing to pay ever higher prices for these higher cost of leisure.
All right. Well, gentlemen, stay with us because we're going to bring in senior markets commentator Mike Santoli over at the market dashboard at the New York Stock Exchange for a closer look at a key inflation read that is on the way. Speaking of, hi, Mike.
Yes, Morgan, hi. Tomorrow we get the PCE consumer inflation numbers. Those are the ones that are directly looked at by the Fed. They're in the Fed's models, and that's what represents the Fed's inflation target. Now, the Fed, of course, has been chasing inflation for the better part of a year, just about a year, and has just about caught it if you look at the comparison of the Fed funds rate, which, of course, is the one the Fed controls relative to the core PCE inflation rate. This is a longer-term chart, goes back more than 20 years, and you see that we've gotten this massively steep tightening cycle. It's brought in the upper bound of Fed funds right now to 4.75%, and that is slightly above the last reported core PCE level. Now, tomorrow, you're expected, based on economists' forecasts, to see a little more improvement in the inflation rate. Core PCE projected at 4.3, so just a real incremental decline. And I think there's a lot of discussion as to whether, in fact, there might be an upside surprise because of some stickiness and some methodology issues. But what you'll see is in past cycles, the Fed did get the Fed funds well above the inflation rate before the overall cycle ended. This was 2 years or so before you got to a recession. That's been the case in the past as well. And look at the long period of time where Fed funds remained below a low inflation level back in the 2010s. It shows you what a radically different world this is. Now, if inflation starts to really decline toward the 2% target, you're going to find the Fed funds is being very restrictive, and it's slowing down the economy as expected and creating a higher real interest rate yield that people will necessarily believe is both going to do the job on inflation and maybe bring inflation risk, recession risk, but not necessarily on an immediate basis, guys.
Love this chart, Santoli, because this is it. This is the whole debate around sufficiently restrictive and just how quickly disinflation can continue from here, especially given the fact that we have had these stronger and hotter than expected reports in recent weeks that have surprised everybody.
Without a doubt. And it's interesting because now that so far, as far as we can tell, the Fed is on this pace of perhaps a couple more quarter point increases. What it means is you get a quarter point every meeting. That's every 6 or 7 weeks. You're always going to have another inflation reading between the meetings, sometimes two, right? So that means it gives inflation time, if it's going to go down on its own from here, to actually moderate more, and so the Fed doesn't have to do as much on the rate side. So that's the phase we're in right now, where they've already done the sprint. Now they're doing kind of the jog to maybe complete the move.
How good does the news have to be, do you think, to counter some of the rough news that we've had for those who are hoping that the Fed's going to ease off, including that hot jobs number and, of course, the hot CPI?
It's got to be good, but not too good. If you're talking about the pace of the economy itself, you do see some sensitivity to hot labor numbers like the low unemployment claims out there. But really, I think if the Fed is going to be pausing, I've never been of the view that the stock market really needed the Fed to outright be cutting rates later this year to remain, relatively well supported. It just needs the Fed to kind of find where it's going, stay there for a bit, and then be data dependent from that moment on. And of course, if we immediately dump into a recession from there, not good for stocks at all. But I don't think that's necessarily too imminent at the moment.
Let's hope not. Mike Santoli, thank you. Meanwhile, we have a news alert on Boeing. Our Phil LeBeau has details. Phil.
John, take a look at shares of Boeing, the company confirming also what we have confirmed through the FAA, that the company has suspended deliveries, halted deliveries of the 787 Dreamliner while they do further inspections on a fuselage part. Unclear when they started halting deliveries, though. It has been reported by the Wall Street Journal that the last one that was delivered was in late January. But again, this is a part of the fuselage, a component that Boeing is doing further analysis of. And at this time, they have not suspended production. It's simply deliveries of new Dreamliners. Now, they don't deliver a lot of them every month. Remember, they halted production all the way up through May of last year. It was halted for about a year while they were working with the FAA on documentation and analysis of inspections for new planes as they are built. This is completely separate. This is analysis of a component within the fuselage that Boeing is doing, and until they have finished that analysis and they are comfortable and the FAA is comfortable with what the analysis shows, they are halting delivery. So that's the story with Boeing, guys.
Well, we know you'll keep an eye on that as the situation develops, and of course it comes in the same day that you just spoke to Airbus's CEO just earlier today, speaking to that competition right there. All right, want to also get Carvana from Phil, because you have those results.
We're dancing here. We've got a number of things on our plate. Take a look at shares of Carvana. The number that we're going with here is a loss of $7.61, which is far worse than the estimate of a loss of $2.28. And by the way, the most dire prediction from an analyst for the quarter was a loss of $4.27. So we're crunching those numbers again to make sure that what we have, a loss of $7.61, is in fact what the company reported for the fourth quarter. Revenue falling shy of expectations, coming in at $2.84 billion. The street was expecting just over $3 billion in revenue. But again, there you see shares of Carvana down a little under 4% on a loss on both the top and the bottom line. Guys, back to you.
All right, Phil LeBeau, thank you.
You bet.
This time for real. All right, I want to bring it back over to the panel. Adam, your thoughts, whether it's on Boeing or Carvana, or perhaps more pressingly looking to the market tomorrow, PCE, which we know is the Fed's favorite gauge of inflation.
Sure. So I'll try to touch on all three. On Boeing, demand for aircrafts is off the charts, just as we're seeing in travel. Orders that are being placed for these companies are extremely strong. Boeing in particular has had a lot of manufacturing and supply chain issues, which is preventing them from really capitalizing on it. And this is just another example of that. On Carvana, the situation is a little bit like Warner Brothers. I'm curious to see the cash metrics within the report. The EPS number probably has a lot of noise in it, but this is a company that has had a lot of liquidity concerns surrounding it. So it would be very interesting to kind of see the cash momentum, cash dynamics, and then any commentary they have on liquidity on the call. And then finally on the PCE tomorrow, so the PCE is the last major number of the month that we get. So we start with jobs, we get the CPI, PPI, import-export prices, and then the PCE. So all the data for January has been very hot. I think people anticipate the PCE to be very hot as well. But most people are kind of moving on now to the February data, and that doesn't hit for another 2.5 weeks or so. So the February jobs report arrives on Friday, March 10th, which is a little later than normal. It's about a week later. And I think that's what the number of people are really watching now, is kind of what happened in February versus January.
All right, and Paul, give you the last word on what we've seen so far. Still got earnings coming out, but a little bit more muted in terms of how exciting they are. No NVIDIA yet today.
Well, so I think, Adam just summed up everything coming after hours, but I think two things worth highlighting. Look at tomorrow, the inflation expectations in the Michigan Confidence Report. Inflation expectations on the part of the consumer have been pretty well behaved, and they've been coming in, so that's positive. Look for that trend to continue. And as Mike was talking in his prior segment, the level of interest rates is very important, but just as important is the direction and how fast they're moving. And if we can get some stability in interest rates, that's a sign that we're sort of at an equilibrium level, as opposed to the Fed rapidly increasing rates or rapidly decreasing rates, which tells you they're behind the curve in either direction. So I think even if you get a flat level of interest rates going forward, and you get some data to support maybe a pause or 25 basis points, markets can do well with that.
All right. Thank you, Paul, and thank you, Adam, for joining us.
Up next, we're going to talk to the CEO of game engine Unity Software, which is giving up a big chunk of its gains on the year today after guidance missed the mark. You can see shares finished down 16%. We're back in 2. Stay with us.
This story went from a dilapidated, rundown duplex all the way to the White House.
Mr. Haley was surprised at how easy it was to make an extraordinary amount of money by doing essentially nothing. How far would you go?
You can smell the money. That's why the clients come here.
For money.
$40,000 would be paid for the killing of the judge and the prosecutor.
American Greed on CNBC.
This year, we are looking at the growth from the source of growth which is coming from domestic, which is consumption and investment. They are all recovered very strongly. For example, like on consumer, the consumer confidence is still continue very high. Inflation in Indonesia is relatively very moderate, 5.3%. And this is despite we've already increased our fuel price last September.
He's the U.S. Special Presidential Envoy for Climate.
If we will generate enough economic activity around the explorations that need to take place, we can win the battle.
2024, the election coming up. And what happens if there is a change of government?
I do not believe any one politician or any one country could turn around what is happening with respect to response to climate.
I sit down with John Kerry on the next Sustainable Future.
Steve Kovac has the results. Steve.
Hey there, Morgan. Yeah, look at shares of Block falling here after a miss on EPS. 22 cents versus 30 cents expected for EPS. Revenue was a slight beat, though. $4.65 billion versus the $4.6 even. billion that the street was looking for. And then as far as Bitcoin on the balance sheet, I know we'd like to pay attention to that. The fair value of that is $133 million. You see shares now down about 5%. The call begins at 5 o'clock, and we'll have more for you right then. Morgan, back to you.
All right, I'll take it, Steve. Big mover. I know you continue to watch it. Meanwhile, shares of Unity falling sharply on the back of its results came out last night. The game engine and kind of app ecosystem platform saw upside in the fourth quarter on revenue and margins, but investors focusing on the guide, which mixed revenue expectations. Joining us now in a first on CNBC interview, Unity's CEO and chairman, John Riccitiello. John, you didn't talk a lot about the ecosystem headwinds, about Apple making things more difficult to target as being a problem for revenue going forward that you're overcoming. You talked more about the economy, but how much of it really is that targeting challenge?
You know, I think that's really in the past at this point. You know, we're dealing right now on the ad side with, you know, some headwinds that are more economic driven. But just for clarity, you know, we had our first profitable quarter as a public company last quarter, beat expectations on revenue. We guided for the year for $300 million on the top side for profitability, well ahead of street expectations. And so our first quarter, we guided very conservatively in sort of a period of economic turmoil. What we're talking about right now is pretty straightforward. We're doing sharp cost containment to make sure that profitability and cash flow comes through for our investors, and market share growth. Well, it's a little hard for us to predict on the ad side in particular what the state of the market is. We're calling it stable, and we feel good about that.
So how much of the revenue, the conservatism that you're taking toward that guide also has to do with your being focused on protecting that profitability and those margins which are coming up?
Well, look, this is one of those wildly philosophical thesis points. But look, every now and then the market goes through the kind of a gyration that's going through right now. I personally think that's healthy. It puts us in a position to get our costs at a level such that when the market does recover, we can have explosive and profitable growth on the backside of that. Now, we're still guiding to strong profitability even without that. Our assumption going forward is no recovery for 2023. I'm hopeful it can be better than that. But we're able to hit that strong profit note with a conservative guide. And we can do better than that if we start to see market recovery.
So, John, just to dig through where the profitability comes from, I know you started in gaming, and certainly Last night, we heard NVIDIA say that they're expecting a rebound in their gaming business, but you've also been diversifying to other industries as well. So where are you finding the most opportunities in terms of that profitability?
Well, first off, we have two divisions, Grow, which is around user acquisition, it's more ad-driven, and Create is the tools that they use to create new product, whether it's a game, a digital twin, a replica of the city of Orlando, for example. We're seeing strong growth in Create almost regardless of the economy. There's interest in gaming, we're seeing growth there. We grew over 100% in industries outside of gaming last year, so the industry side took off really well. Where there's headwinds is in the advertising business. It's often said, first in a recession in the ad business, first out of a recession is the ad business, as you go from fear to greed and greed to fear, in terms of advertising buyers trying to build the businesses of the companies they support. So right now, Create overall feels super healthy, strong, but strong growth. And on the ad side, we're taking a particularly conservative view looking forward because it's frankly hard to read. I mean, a few moments on your own show, you were showing graphs on interest rates, et cetera, that look like a Rorschach test. I mean, it's just hard for people to see through them. And because they can't see through it, I don't see there's a whole lot of benefit in us anticipating something that we can't be sure about. Hence, conservative guide, making sure the expenses yield the right profitability with that conservative guide, and being ready when the market recovers to really deliver on the top line and the bottom line.
So then, John, tell us about the payoff on Iron Source, which already seems to be doing pretty well for you, but that's that part of that Grow business that you acquired. There's a weird situation where AppLovin was trying to get you to fall in love, and you said no. But to what degree are those customers who need efficiency, even in a tough ad environment, going to migrate toward a solution like the one you have versus that solution is just going to suffer in the macro?
Now, one of the things we pointed out yesterday on our earnings call is that we're seeing market share gains today in the market, but they all don't drop through to revenue in the first quarter. You know, customers move to our platform, and then there's a period of engineering integration before the revenue kicks in. So we're already seeing early signs of people coming to our platform, market share gains that speak well for the long term. But in an area where you've got to engineer the migration of their games onto our platform, the revenue takes a little bit to materialize, and hence we're showing stronger revenue growth year over year in the back quarters of this year than in the first quarter of this year.
All right, that conservatism, which the street is reacting strongly to this week, we'll see how it turns out. John, thanks for joining us.
Thank you.
Now, after the break, we're going to get an analyst take on Block's report and what it says about the state of fintech and consumer spending.
Plus, I spoke with Norfolk Southern CEO Alan Shaw in his first sit-down interview following the East Palestine train derailment and subsequent release of toxic chemicals that happened earlier this week. And I asked him about the cause of that accident in Ohio that happened earlier this month.
We have a lot of confidence in the NTSB. We're looking forward to seeing the results.
Well, the National Transportation Safety Board's preliminary report out today. Sooner than expected. We're going to tell you about the key findings next.
Today's Forex update is presented by Interactive Brokers. 125 markets, 31 countries, 24 currencies. Today's Forex update was presented by Interactive Brokers. Gateway to the world's markets. One world, one account.
At Interactive Brokers, independent RIAs work with the best research and trading tools designed to help them outperform the markets. Meet them at Interactive Brokers Investors Marketplace for advisors. Advisors at Interactive Brokers keep all they earn on our low-cost platform, with no ticket fees or custody charges, low margin rates, and high interest earned on idle cash. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
We
We still see that the business is doing well with the energy transition. However, that we still obviously have to do homework with regard to the wind business.
It's about investing in accelerating the energy transition and at the same time investing in today's energy system.
We expect quite balanced markets with the oversupply in China now looking a bit lower than what we thought just some time ago.
We hope to be able to support our customers on the journey to decarbonization and towards net zero.
Building back the economy.
Inflation data in focus this week.
Squawk Box.
Welcome back. Autodesk earnings are out, and the stock is down just over 2.5%. Might be a bit of a head scratcher because it looks like, at least in line, if not a bit of a beat. Revenues came in at $1.32 billion versus $1.31 billion expected. Adjusted earnings per share came in at $1.86 versus $1.81 expected. But one thing that caught my eye here was the guide on full year billings. That came in at $5.025 billion to $5.175 billion. The street was looking for 5.173. So the high end of the guide, just barely what the street was looking for. So that might have this be what the cause is of the stock being a bit under pressure. And tomorrow, I'll note, we're going to hear from Autodesk CEO Andrew Anagnost here on Overtime. So we'll get into these issues of the guide. More can see how much conservatism plays into that versus other issues, right, with people designing buildings, other infrastructure, which is, of course, Autodesk's core business.
That seems to be the word of the day, conservatism. And of course, it comes on the heels of another similar, we'll call it a peer company that also reported and was one of the best performers in the S&P today, and that was Ansys. That was up 10.5%. Yeah. We'll check out shares, speaking of earnings movers, of Block. Fourth quarter numbers are out just a few moments ago. You can see shares are popping 2% now in after hours. And for instant reaction, let's bring in RW Baird's David Koning. He has an outperform rating and an $85 price target on the stock. David, thanks for being on. Your initial takeaway from the results we got in the report just a few moments ago.
Yeah, thanks. So EPS, a little disappointing. That was just on a tax rate. Seller decelerated a little bit. That was expected. The big positives, Cash App crushed it. They accelerated meaningfully well above the street, and January and February trends accelerating very nicely. The street's modeling deceleration in Q1, so I would think the stock should be up nicely tomorrow.
All right, how much does Bitcoin matter to this name? Because we have seen it become one of those stock proxies for whatever the price of Bitcoin is doing, and I realize it's only just a part of their business.
Bitcoin mattered when Block was at $250. At 70, it just doesn't matter. It's 4% of gross profit. I haven't even looked closely at it. That's how much it matters.
Understood. All right. Well, David, thank you. We're going to be watching for that conference call.
Thanks, guys.
Maybe they should change their name back to Square. But for now, time for a news update with Bertha Coombs. Bertha.
Hey, John, here's what's happening at this hour. President Biden plans to meet virtually tomorrow with the leaders of the G7 countries and Ukrainian President Volodymyr Zelensky on the one-year anniversary of the Russian invasion. The White House also says President Biden will announce new sanctions against Russian individuals and entities. This afternoon, the United Nations General Assembly passed a non-binding resolution calling Russia to end its military operations in Ukraine and to withdraw its forces. That vote was 141-7, with 32 countries abstaining, including China and India. And in Paris, the Eiffel Tower is lit in the blue and yellow colors of the Ukrainian flag. At a lighting ceremony, Ukraine's ambassador thanked the city for its support. Amazing milestone, Morgan. Back to you.
Bertha Coombs, thank you. The National Transportation Safety Board releasing its preliminary report faster than expected on the Norfolk Southern train that derailed in East Palestine, Ohio, resulting in the subsequent release of toxic chemicals. In a press conference this afternoon, the NTSB saying the cause of the accident was an overheated wheel bearing, and Chair Jennifer Homendy saying so far no signs of operational issues with the hot box detectors that are installed along the tracks that ultimately alerted the crew to stop the train, no sign of track defects, and no evidence the crew did anything wrong. But it's just the start of this process, with regulators even taking the rare step of launching an investigative hearing.
What are we investigating that's preventable? Pretty much everything about this accident. It's everything from the wheel bearing to the rail cars to the tank cars to the actions of federal entities or inaction of federal entities. We'll look at state entities. We'll look at locals.
And of course, look at Norfolk Southern as well. Earlier this week, CEO Alan Shaw sat down with me in East Palestine for his first interview in the wake of this environmental disaster. And I asked him if the accident has already affected the way he's staffing the railroad and thinking about investments into the network.
We're going to figure out what caused this and what we could have done to prevent this. And we're going to learn from it, and we're going to make changes based on that.
Does there need to be a change to the way that hazardous materials moved by rail are classified, as some lawmakers, and by the way, from both parties, have been suggesting in recent days?
I'm anxious to see the results of the NTSB report, and we're going to sit down with the regulators and those lawmakers to figure out what the best solution is to make the rail industry safer.
Just getting a statement from Norfolk Southern in the last few moments on the heels of this NTSB report. Very lengthy statement breaking down some of the results and what we've heard today already. But the company going on to say that it's now inspecting all of the nearly 1,000 wayside heat detectors on its system, those hot boxes on top of the regular inspection that those detectors go through every 30 days. Also saying that Norfolk Southern will develop practices and invest in technologies that could help prevent an incident like this in the future. And they will work with the owners of the rail cars on the integrity and safety of the equipment they use as well, because that is now very much in focus, the state of the rail cars.
And of course, you are just the person at this network who I want to be talking to try to understand this. Is this really about, of course, primarily it's about the safety of the people of East Palestine, but from the corporate perspective, margins, because the workers have been arguing, hey, Norfolk Southern and others, you're understaffing here. We need more backup people on these train cars. You're cutting corners in certain areas, and this was bound to happen. And the company is largely, it seems to me, have been saying, we got technology coming that can do the job here. Do they? Is it really the workers gaining an upper hand, perhaps, in this argument?
I will say, as this investigation has been unfolding, you've certainly had lawmakers, politicians, unions coming out and very much increasing the scrutiny on and the speculation around this accident, but increasing the scrutiny on, for example, precision scheduled railroading, what's called PSR, in which most of the rail industry has adopted in recent years, including Norfolk Southern. And the idea of PSR is to basically run longer trains, cut costs, cut workforce, and be able to, through that process, increase service and with it profits. That was already under scrutiny with the pandemic and the fact that you had rail networks that couldn't debottleneck fast enough, given everything we were seeing play out. It was in scrutiny with that, almost labor strike we saw coming into the holiday season just a few months ago. And now, of course, for better or worse, it's in focus here. But as this investigation plays out, what is not clear is just how much a strategy such as that and the headcount specifically played in the possible prevention of this derailment. Yeah. I do know from Shaw and the conversation we had earlier this week, and I've had this conversation with them before, Norfolk Southern, and by the way, the other railroads, they've actually been hiring. They cannot get enough workers right now and hanging on to those workers. So we'll see. There's more questions to be answered.
Yeah, and a lot more than dollars at stake. Again,
absolutely,
health and safety, but dollars too. Now coming up, the IPO market has been largely frozen for the past year, but is a thaw in the forecast? We're going to ask Wedbush's head of investment banking next.
been as important for our industry to come together. There is nothing more powerful than the human connection.
The technology will help us push to the limits.
Because belief is what will drive true engagement.
Together we can do incredible things.
Everything is happening at amazing speed.
Despite all the challenges that we had to go through with the war, the sanctions, the move from equities to rates, a very healthy year, annual performance as well.
In the last 8 quarters, while being up year on year, we beat analyst consensus by an average of 30% every time, which means that the market has not adjusted to what our true run rate is.
We do have a lot of knowledge of our customers and portfolios, and the guidance we give at the group level has delivered once again in what has been a very different year than what we all expected.
The fourth quarter it tailed off a little bit for us, but still was a record quarter in our FIC business. We're thrilled with that performance. But as you say, it came a little bit short of analyst expectations and our guidance.
We said this is a 2 to 3 years transformation. We also said we would unfortunately expect a loss in 2023 whilst we are going through the transformation further. And from there on, we will getting profitable.
For Sweden, together with Finland, could that also file an application for NATO? And that's why we're so eager also get into the alliance. And we think that we can be security providers to the alliance because we have assets and capabilities that can make NATO stronger. We have a strong air defense, we have Patriots, we have Gripen fighters, we have submarines, we have a strong defense industrial base. We also have great Russia expertise in our intelligence community.
Market activity really come back? Let's bring in Wedbush, Head of Investment Banking, Burke Dempsey, who is on set with us. Welcome.
Thank you for having me here. It's great.
You agree with Jamie Dimon? Soon?
Soon, but you have to look back over the last year. It's been pretty dismal. We're down 80 to 90%, whether you measured it on deals or on volume. And this first quarter, so far year to date, it's looking a little bit better. But I think, you've got a situation here where you got a standoff between buyers and sellers. Companies wanted 21's prices still, and investors today want 23's prices because they're a little uncertain. So I think when you see some year-end audits come through, which you're seeing now, and then you also get to some hardboard conversations that are going to be had, I think you're going to see some action. So I think he might be right there.
So in terms of deal making specifically, do you expect we're to see more companies come public this year, or you think there's going to be more M&A? How are you looking? How are you assessing the landscape?
Well, if I go back in time, the standoff usually takes 6 to 9 months, and it's been through cycles. I've been through them, and I think what will happen next is that we're going to end up starting with things like convertible preferred restructuring type deals, because you got to get people sort of out of the mud first who are in there. You got to stabilize things. People are cautious right now. So if you do a convertible preferred, you give somebody a preference over the common, and you give somebody a nice yield, and you give them some equity upside. It's a little defensive, and it has a little upside. So I think that's what people want to see right now. You just saw Bed Bath & Beyond do quite an amazing one, and at the same time today, Southern companies did one. One company was a D-rated company, and one company is investment grade. So it's something for everybody. The next, unless you had a question, the next thing you're going to see is spin-offs and split-offs, which is the beginning of an IPO kind of trend, where people have an embedded company and they can get better valuation for it than their whole company. So we work with them to spin it out. Maybe we JV it. Maybe we sell it all the way. That's another one. And well, I think that's where it goes.
I do have a question, but I also really wanted to hear what you had to say about that. And my question is, where does private equity fit into this equation? Because end of last year, beginning of this year, when things looked really ugly. They were licking their chops, and you saw them coming in, taking out a lot of tech companies. But it seems like it's been quieter lately as the market has turned up. So does that mean they stay quiet if the market doesn't tank again, or is there a recalibration and re-entry you think we're going to see?
There's a couple different things there. Private equity is always looking. We bankers are always talking to them, every week, all the time. At certain times, their ability to pay is not as good as a corporation's. Corporations have the strategic ability to merge, get consolidation savings, et cetera, that some private equity firms don't. Now, private equity firms over the last number of years have gotten bigger, and they have platform companies, so they're semi-strategic. But the final part that private equity likes to do, they like to use some leverage, and so they need their banks to cooperate. Well, the banks are sitting on some loans when interest rates went up that are upside down. So they really don't necessarily want to jump right back in that game again. So I think that's kind of what's happening. That's why it's a standoff.
We've obviously seen this huge downdraft in public markets in the past year plus. Not so much in private markets. And I realize there tends to be a lag effect. Going back to sort of your first question and your first comments, are you seeing that start to catch up in the private markets now?
Yes, people are a little more rational, but some of these smaller, there's all sorts of private companies. There's hundreds, thousands of them, right? And so I think there is a little bit of denying reality because they can do that. But I think as you're seeing these board meetings go for public and private companies, and we're working on some where they're saying no mas, there's no more money, make it work. So that's going to push some of these companies into a deal or do something, a down round. No one wants to do that, but that's what's going to take to get back to stability.
All right, Burke Dempsey, thanks for joining us.
Thank you.
All right, and we gave you a little bit of Jim Cramer's interview with Jamie Dimon there at the top. We've got a lot more coming up, 6 p.m. on Mad Money.
It's been a busy day after hours. A lot of earnings. We're going to tell you about the $100 billion market cap company that's pulling back when overtime returns.
I was surprised how much energy I get from art.
I believe that art starts where language stops.
I see it very much as a switch-up change of my daily life. It's more peaceful, it's like going to a church.
Well, I think it's very important to do other things, to come here together with Ugo and create something. You learn more maybe about yourself.
In his field, he's an artist.
What makes us who we are, if not the way we experience the world? Because while first class is something you can buy, world class is everything we do. Welcome to world class. Welcome to Singapore Airlines.
Accor, the company beat expectations for annual core profit, boosted by demand for shorter trips and a recovery in bookings. The French hotel group reported 675 million euros in full-year EBITDA.
We see more people over weekends staying for personal reasons, i.e. doing so-called leisure, a combination of business and leisure. We've got in our hotels the capability to basically get the people to do that kind of activities, i.e. working from the hotel.
Content is key. A non-branded film about real lives.
Not branding the film was very intentional. I wanted the story to be about the journey of the person.
It was a huge leap of faith, and if we didn't have that relationship, we wouldn't have done it.
A takeover evening to get the message across.
I've made it focus on people, adding an abstract element to it, with their logo in the middle.
We explore Publicis Sapient's new campaign on the next Marketing Media Money.
Take a look at shares of Intuit, moving lower right now in overtime. It's been up and down a bit after hours ahead of the call. The financial software company handily beating estimates, reporting earnings per share of $2.20 ex items versus the streets, $1.44. Meanwhile, revenue came in at just over $3 billion. Estimates were for 2.91. Company also announcing a CFO change. Sandeep Singh Aujla will replace Michelle Clatterbuck effective July 1st. And we're going to hear more on this. You're going to hear from CEO Sasan Goodarzi on Overtime tomorrow. Morgan, we're getting to the bottom of all of these.
In case you haven't noticed, we're going to have a very busy Friday afternoon. Up next, the boom and bust of two companies that took big-ticket purchasing experiences online, and one of them just reported earnings. Mike Santoli is going to break down the charts when Overtime returns.
The reward goes only to the willing. CNBC presents The Brave Ones, profiles of bold leaders who took the leap and changed the world.
I think our move into space has been our boldest move.
He's a high-flying CEO pushing the envelope at every turn.
He's a rock star within the business world.
With an extraordinary vision for the future.
He has always been at the edge of pushing the next thing.
The Brave Ones, Richard Branson. CNBC.
Ambition is in my DNA. My grandparents came over from China. They opened up a laundry in Buffalo, New York. They achieved their American dream, so I can have mine. It's a privilege to help viewers out there make better investment choices so they can achieve their American dream. Reporting earnings. It's more than doubled this year, but it's still down, get this, 90% from its peak. We're going to talk about the rise and fall of that name and another stock that's made similar moves next.
Today's Forex update is presented by Interactive Brokers. 125 markets, 31 countries, 24 currencies. Today's Forex update was presented by Interactive Brokers. Gateway to the world's markets. One world, one account.
China is very important for Australia in general because the largest visitors internationally that came to Australia were Chinese. So we think that's going to be great for our economy here, which has a knock-on effect onto Qantas. And we get the benefit of those Chinese visitors domestically, which are a huge proportion of people traveling around the country. So we're optimistic that that starts recovering, and that will be good for us, particularly in our domestic business.
building back the economy.
Inflation data in focus this week.
Squawk Box.
He's the U.S. Special Presidential Envoy for Climate.
If we will generate enough economic activity around the explorations that need to take place, we can win the battle.
2024, the election coming up. And what happens if there is a change of government?
I do not believe any one politician or any one country could turn around what is happening with respect to response to climate.
I sit down with John Kerry on the next Sustainable Future.
Let's get another look at Carvana because those shares are up about 2.5% after hours. Senior markets commentator Michael Santoli is back with a breakdown of the boom and bust. Michael.
Yes, so obviously ugly results from Carvana, but not too different from expectations. But let's span back to the middle of 2020, I guess. We're going back to the Open Door IPO, or when it first came public. That, of course, is a company that promises to buy or sell your home very quickly in a very up-to-date e-commerce-y way. That's the same thing Carvana is doing for you for used cars. And you see very similar paths here. Now, not exactly synced up, but essentially a 300% move off of that starting point at the peak, and now we're kind of bumping along the lows. Now, yeah, Carvana's more than doubled off that bottom, but it shows you deep skepticism about the viability of this business model. And of course, Carvana has some debt outstanding that yields massive in the 20%, 30% area. So clearly, lots of overhang on these stocks. But right now, looks like Carvana managed to sneak through without incremental worries from this report.
Yeah. All right, Mike, thank you. And finally, some news today out of the White House. The Biden administration nominating Ajay Banga to be the next president of the World Bank. Banga is a face probably familiar to many of you. He stepped down as MasterCard's CEO in 2021. This comes after current President David Malpass announced his resignation last week after months of controversy. The former treasurer and chief investment officer of the organization, Afsana Beschloss, lists some of the top priorities the new president should consider in an op-ed out this week in the Financial Times. And she's going to join us on tomorrow's show to discuss all this and more, Morgan.
It comes at a key time, given the geopolitical landscape, given the global economic landscape. I'm going to be very interested to hear what she has to say about that and also about markets tomorrow.
And some of it has to do with global warming and the World Bank's need to take that on. I'm really curious about the financial underpinnings of that, which Afsana is so good at, because I know that sometimes gets bandied about as a political thing.
Well, we're going to have to ask her all about it tomorrow. That's going to do it for us here at Overtime.
That's money.
He's been the top diplomat in the U.S., and he's now the country's first ever special envoy for climate. Let's find out what John Kerry thinks is in our sustainable future. Hello and welcome to the show. I'm Tanya Breyer here at the World Economic Forum in Davos, Switzerland, where I speak to one of the world's most influential people in the fight against climate change, the US Special Presidential Envoy for Climate, John Kerry. He has an impressive record on the world stage. Most notably, he was the Democratic nominee for President of the United States in 2004, losing to the incumbent George W. Bush. In 2013, he became Secretary of State under President Barack Obama, a position he held until 2017. The job saw him help negotiate the Trans-Pacific Partnership, the Iran nuclear deal, and in 2015 he helped push through the historic Paris Agreement in the battle against the climate crisis.
So we gather this week in Paris, knowing that the Conference of the Parties, this Conference of the Parties, may be the best chance we have to correct the course of our planet. And we gather to chart a new path, a sustainable path, to prevent the worst, most devastating consequences of climate change from ever happening.
The deal did happen, But the years that followed were difficult ones. In 2020, President Trump officially withdrew the US from the deal, saying it was a death sentence.
One of the things I got you out of is this thing sounds so good, but it's so bad. It's a rip-off of our country, the so-called Paris Climate Accord. It's a disaster, a death sentence. It's a death sentence for your energy jobs. I took it out.
Just over a year later, the Biden administration rejoined.
We're standing at an inflection point in world history. We have the ability to invest in ourselves and build an equitable, clean energy future, and in the process, create millions of good-paying jobs and opportunities around the world. Bring a better day.
President Biden moved fast. Days after winning the election, he established a new post in the executive, the United States Special Presidential Envoy for Climate, and he turned to John Kerry to fill the role.
Thank you, Mr. President-elect, for your generous words. And most of all, thank you for the trust and the responsibility of this appointment. I will do all in my power to live up to your expectations and to this moment for our country and for the world.
In his new role, John Kerry was instrumental in a hard-won battle to get the Inflation Reduction Act passed. It's a $369 billion package of climate investments. Estimates say it could cut US greenhouse gas emissions by 40% by the end of the decade. Last year, Kerry was in Sharm el-Sheikh, Egypt, for the latest UN climate talks, and he helped push through an agreement to provide loss and damage funding for poor countries hit hard by climate change. I caught up with the special envoy at the CNBC sanctuary in Davos, Switzerland, on the sidelines of the World Economic Forum.
The theme here at the World Economic Forum is cooperation in a fragmented world, fighting the climate crisis. Is cooperation realistic, given the partisan differences that we're seeing not only in the US, but around the world?
Well, first of all, thank you. I'm privileged to be here. Yes, of course it's possible. I mean, there's no reason in the world. And there is a remarkable amount of cooperation. I just came from a conference in the UAE on sustainability with people from all walks of life and different companies, all of whom, yeah, there's competition, but there's also a sense that we're all in this together, and we've really got to up the game. We've got to accelerate the reduction of emissions, but also accelerate the other key components of getting to neutrality and of doing this in a way that is just and doesn't leave the global south behind and so forth. It's a very complicated but exciting process.
Of course, China's vice premier is here at Davos too. Have you spoken to him yet? And what are relations like now between the US and China, a very important relationship in this fight?
Well, no, I know that he is here. I've not yet had a chance to either bump into him or see him, but I'd be happy to. I mean, it'd be something that I would want to do. I have resumed, and the United States has resumed formal discussions with the Chinese. We've had several meetings to date, and we'll be talking very shortly. We will be meeting again soon. And we very much hope to be able to find the pathway to a breakthrough that could make a huge difference, since China is, of course, 30% of all the global emissions, and the United States is at about 10 now. And we are on a pathway, however, to keep the warming of the planet limited to the 1.5 degrees, together with a bunch of other countries. But we need more countries to be joining that group. But I am encouraged that there are major technologies on which we are poised to have a breakthrough. There's a tremendous global effort taking place. There's much more awareness. I find we're not in a battle now to convince as many people that this is happening and you have to change. We're in a mobilization effort and a new moment, I think, for the movement, because people are finally beginning to really see what the implications are of not taking action.
And of course, COP27 ended with an agreement to provide loss and damage funding for the poorer countries hit hard by climate change. But the details are still unknown. How much is the fund worth and where would the finance come from?
Well, those questions are legitimate, but they were all left specifically to the process this year to try to provide the answers to those things. It is appropriate that people are really focused on the consequences of this crisis that we're facing. And there are many countries in the world, the most vulnerable nations, that are not responsible for what is happening, but who are getting the impacts full on. And so, I mean, it's meaningful that in Africa, for instance, in sub-Saharan Africa, there are 48 nations that equal in total 0.55% of all the emissions. But then on the other side, you have 20 major economies that are responsible for 80% of all the emissions. So you don't have to work hard unless you have no heart and no brain to understand the degree to which justice is critical, inclusivity is critical, and action is critical, urgent action to begin to reduce those emissions fast enough that we do what the scientists are telling us we must do, which is avoid the worst consequences of the crisis. And we only avoid the worst consequences if we can hold the Earth's temperature increase to the 1.5 degrees. And we're on the edge. There are some scientists who will tell you you've already blown past it. There are some who will tell you, no, we may be able to have a little overshoot, but we can do a clawback and come back to hold on to the 1.5. All I know is we're not on track to hit the 1.5. We should be, we need to do everything in our power to move in that direction. That means